Hi, the content you're about to see is usually reserved for the premium members. So every day there's a new video for the premium members, which is currently $49 US per month. We've got videos on the general macro view, as in where might Bitcoin, where might crypto in general go. And we've also got videos discussing smaller altcoins, arbitrage opportunities, DeFi plays, etc. So today's video discusses the macro landscape. Hope you're gonna enjoy the content. And if you're interested in those daily videos for the premium membership, the link is in the video description. So for today's free video, let's jump right in. Welcome to another Macro Tower update today on the 22nd of May 2022. And we are going to really have a macro view over here. We are going to zoom out a lot over here. You've very likely never seen this kind of a chart, but I find it super interesting. This chart starts in 1908. So this is more than 100 years of data. And what this shows is the gold price relative to the S&P 500. So the gold price divided by the S&P 500. And the magnitude of these swings is massive. Here, look at this from 1967 all the way to 1980, we had a 1,600% outperformance of gold versus the S&P 500. And then we had the exact opposite from the 80s to the dot-com bust, a drop of 97% roughly. So stocks here completely outperformed gold. If you held gold during this time period, you would have not done very well. Now, gold is very often just used as a portfolio diversifier, right? And this kind of shows the point. If you don't really actively rebalance, and this is really very inactively, right? These are swings of 10, 20 years. If you just have different kinds of asset classes in your portfolio and you never ever look at this again, then you do get some kind of diversification benefit. Because if you held everything in gold during this period of time, you would have not made very well. If you held everything in gold though, in the 70s, you would have done pretty well. Now, there's a lot of different explanations for this out and underperformance, right? Some people say it's interest rate cycles. Others say it's technological advancement, right? A lot of tech development happened here in the 80s and 90s. Then came the bust. So this reversed. But what I find mainly interesting around this is the cyclical nature of this. So since the time frame here is so long, most people only know the recent past, and they've never seen an environment where gold outperformed stocks by that much, or where we had then this massive turnaround again, and nobody could care less about the gold price. Everybody was in for stocks. And currently we're in a similar situation, right? Nobody really wants to invest into gold, me included. Everyone is just dollar cost averaging into crypto or into technology stocks. Now, what you see over here is a moving average. I've just randomly chosen this. This is the 75-month moving average. Try to find kind of like a moving average that doesn't have too many failed signals. And if you just follow that moving average, right, you probably should do your fundamental research here as well, right? But if you just follow that, you could be somewhat on the right side of history, or at least it gives an indication when it might make sense to not be completely bearish on gold anymore once we go above. We had been slightly above in April of 2020, went all the way to October of 2020. Since then, stocks outperformed again. But when we look at this historically, right, when we say, okay, maybe this is a sideways trading range, and sometimes people are risk on, sometimes they are not, then in relative terms, gold doesn't look too expensive, right? And if you just look at this fundamentally, there is a lot of uncertainty around the economy, right? And around regulation, around inflation, around too much debt. There is, for example, a very interesting video. It's half an hour. It takes a bit of time, but you can watch it on 2x if you want to. I think this video is actually worth watching. So this is by Ray Dalio, How the Economic Machine Works. It basically describes how long-term and short-term debt cycles tend to inflate and deflate asset prices. And this is probably also what we can see somehow around here when the S&P 500 outperforms gold that much. We are very much risk on. A lot of debt is in various asset classes. The debt can't be repaid. It goes bad, and then deleveraging happens and gold tends to outperform by not so little, right? A 7x over here in this movement. And so are we going to stay in this sideways trading range? Of course, nobody knows, right? There's also competition for gold right now. As we all know, Bitcoin is pretty much one of the reasons why not so much money went into gold anymore. That being said, the price movements of Bitcoin nowadays, they more mimic technology stocks than gold. So when we look at the correlations again, right, gold has a pretty low or even negative correlation to, for example, here the S&P 500, right? S&P 500 to gold minus 0.14 in the 180 days rolling coefficient. If you look at the 2-year coefficient, it's slightly positive, but still very close to 0, right? An independent daily return to a certain degree. This is different for the S&P 500 to Bitcoin, where the correlation is increasing over time. It doesn't look that high now with 0.3, but once we look at shorter time periods, it is much more visible, right? We're now at 0.5 of a correlation coefficient. So the prices of stocks and crypto tend to move in the same directions. I think that's not news. For gold, that's not necessarily the case. The problem with gold, though, is that over the very long term, it tends to perform less. Now, what does this mean? It basically is just a reflection of this over here, right? An 80% underperformance, roughly, of gold versus the S&P 500 over this very long time frame. And the fundamental idea always is that gold is a non-productive asset and stocks are a productive asset. Thus, stocks should, in theory, be a long-term better investment. But still, right, the volatility here is massive and it really matters what time frame you take. When you buy gold for relatively cheaply, you can even outperform something like the S&P 500 over the time span of 50 years, right? Over 2 generations, over an entire work career, more than that. So by no means can you be sure to make more money with stocks versus gold if the macroeconomic environment doesn't support that. And so one way to look at this, for example, is you could maybe take the current price. Let's take away this trading range and just see historically, right? When has gold ever been that cheap? There hasn't been that much time where gold was cheaper than today, relatively speaking. Now the question is, do you really think that over the next 20, 30, 40 years, gold is going to continue to underperform and is going to just follow this negative kind of trend? Or do you think we will continue these interesting oscillations? The main message here, I think, is when people talk about the underperformance of gold versus stocks and that gold only returns 1 or 2% per annum, whereas stocks return 7%, I think that's actually an overstatement because you can't really definitively say something like this. If you bought gold in 1927 and you sold it in December of 2011, so you held it for 80 years, you would have gotten the same return for stocks and for gold. I would have expected, with all of this talk around gold being a worse performer than stocks, that we actually would see something like a chart that resembles that kind of a shape. Much more clear of an underperformance, but that's not necessarily what we can observe. This is very different. So let's look at this, right? Let's look at the S&P 500 divided by the Bitcoin price. And let's look at this on a weekly chart. SPX divided by BLX. That's the longest we get. Yeah, this is what a really long-term underperformance looks like. Clearly, Bitcoin, with its increased adoption, was able to significantly outperform stocks, which then indicates that it might make sense to have more money in Bitcoin relative to stocks than what most people think, right? Most people think maybe we should just have a 1 or 2% allocation to crypto and to stocks, and to crypto and to Bitcoin, and have the rest in property and gold and stocks. Now, this would indicate here that even though crypto is riskier, the outperformance justifies taking all of that risk. I think the case is harder to make when looking at gold relative to the S&P 500. Does the outperformance of the S&P 500 really justify being, say, 80% stocks and only 10% gold. Less clear of a case to me, at least if we just simply look at the data. The outperformance isn't that consistent. It's not that free of volatility. Now, I am not diversified into gold because I basically also bought into this whole narrative of gold simply being a long-term poor investment. And over the very, very long term, right, it was not as good as stocks, obviously. But the cycles, they do matter a lot. And the cycles, they are very long term. So if you are in stocks and you hold your position for 13 years and gold outperforms more than 15x, then a lot of people can talk to you about how you just have to look at this a very long term. But in the very long term, right, we are simply dead and the outperformance might be pretty insignificant. So I think it's better to rather try to understand this in detail. Try to understand, why did gold underperform here by 80%? Why did it then in 1929 during the Great Depression outperform by 5x? Why did it then subsequently, even during war times, go down again by 90% relative to stocks? What did then make this big shift in 1967 to outperform again? How do all these turnarounds here develop? What did trigger them? Over here, this is pretty much clear. This is the dot-com bubble. People simply just got risk off. But what caused this risk on environment here in 1980? What caused the risk off environment in 1968? Would be interesting to see if you guys have any explanation for this, so that we can then potentially also get a feeling of when gold might be a good bet again. We are pretty close to that moving average, right? This is a very long-term moving average. We sometimes have failed signals, but more often than not, we've just got very, very large long-term macro cycles. And a lot of people, me included, are not super bullish on stocks. There is a lot of scary things going on with the monetary tightening. Now let's look at two more things here from blockchaincenter.net. So let's look again at the Bitcoin rainbow chart. We are currently in buy territory. We haven't gone up a lot. There isn't too much activity around crypto. It doesn't necessarily make sense to wait all the way until we go here to 19 or even 16K. So historically, even though historically means here a way shorter time frame, right? Since 2012, this is a good time to get in. 2012, what kind of time horizon is this on this chart? It's that line, by the way. So Bitcoin really has only been in a particular type of environment so far. These models here, they are nice, but I would definitely not bet the farm on this. This gold to S&P outperformance over here, this risk-off environment, we've never seen anything like this during Bitcoin's lifetime. Now there's another interesting index here, the alt season index. Does it make sense to be rather in Bitcoin or in altcoins? I haven't backtested this, as in, does it make sense to really follow this and go heavy on altcoins when we are high here and heavy on Bitcoin when we are low here? I have the impression it's probably not working too much, especially in the recent past, given we have been in this sidewards trading range, right? We can almost see the Bitcoin chart in this. Bitcoin bottomed somewhere around here, and it actually would have made sense to be in altcoins when this is low. But the implication of this chart is that it's Bitcoin season, that we should be in Bitcoin right now. I tend to agree with this because finding the exact bottom is really tough right now, and there is not a lot of attention on crypto that pushes up many altcoins. By the way, if you're wondering how this is calculated, it's simply just looking at how many alts are outperforming Bitcoin. So yeah, look at this top 50 performance over the last 90 days, and then just looks at how broad is the outperformance or underperformance. And in the last 90 days, the outperformance was non-existent. There was only 5 altcoins that outperformed BTC, meaning this index here is relatively low. The last 90 days, Bitcoin tended to be an outperformer. In the shorter time frame, right, this is now starting in 2021, this chart, we continue to be in this sideways trading range and we continue to be below the moving averages. We haven't seen a lot of alerts in the indicator alerts channel. We also hold the 30K somewhat well. Now the question is, can we at least go sideways for 1 or 2 more weeks, which could then trigger a moving average cross. Of course, a cross would be better when it doesn't happen during a sideways trading range, but rather when we shoot up. So if we suddenly get a day where we shoot up to 32K or so, this would be very bullish for Bitcoin. So far, we don't see that yet. But the longer we go sideways, the more bullish it is. It shows that at least the very high pessimism doesn't depress the price any further, and that the long-term dollar cost average crew can still stabilize the price enough and fight against this short-term sell-off momentum. Ethereum's picture doesn't look pretty either, right? We are even further away here from the moving averages, which would indicate that Ethereum might underperform Bitcoin over the next few days and maybe weeks. When we look at Bitcoin relative to Ethereum, let's extend this trend. We do see the opposite though, right? This here would indicate that Bitcoin will underperform something like this. So the picture really isn't that clear in the very short term. The attention on crypto is low. Not a lot of people trade crypto. Gas fees are at all-time lows. Attention could be higher, and when it's not so high, it means there's also not a lot of buying pressure besides the long-term dollar cost average investors, which luckily buy in faster than the issuance of Bitcoin. So if current situation just continues for long enough, if there is no attention on crypto for the next 1 or 2 or 3 years, I do expect Bitcoin over that time to trend up, at least versus the US dollar. Now, Phantom is one of the top gainers recently, 16%. Not massive, but it seems to be related to Andre Cronje probably getting more into the ecosystem again. So I'm probably going to make a video on Phantom as well. This is Phantom relative to Ethereum. So it's nice to see that there's some kind of a support happening here. And the potential performance, of course, is also very attractive here. The overall sword of Damocles is obviously the greater market. If technology stocks continue to go down, then this is unlikely to reverse. And as we've just established, Bitcoin first has to go sideways, at least for a while, to be called somewhat stable and not to be completely bearish on this, right? As long as we are far below the moving averages, this is bearish for Bitcoin. So I wouldn't bet the farm now on Phantom suddenly reaching new all-time highs again and shooting up from here. But good news is good news. We shouldn't completely ignore them. I do like the Phantom ecosystem. What I don't like about Phantom is that the gas fees, they can shoot up quite massively. So this is actually underrepresenting the actual situation. This is the average gas price chart on a given day. If there is a lot of demand due to heavy price movements for transactions or due to a new release, etc., these gas fees can really explode. So we're really seeing the limitations of the Phantom blockchain, which is something that I really think should be fixed. Because even though a swap with those higher gas fees only costs, say, $3 or so at the current Phantom price, if the Phantom price goes up again and if there's more attention, then suddenly those swapping fees might getting close to what we have to pay on Ethereum. And then what's the point of using something that's way more centralized like Phantom? So this is something I really don't like about it. What I do like about Phantom though is the very nice market cap to total value locked ratio. So when we look at that, we see it's at 0.64. It's basically one of the cheapest blockchains out there in terms of gas token versus money locked in the ecosystem. This is the total value lock chart of Phantom in US dollars. In Phantom tokens, it looks a little bit better, but also quite a bit of volatility. The gas chart of Phantom looks very different, right? So this is the same kind of chart that we've seen for Phantom, now here for Avalanche. And the Avalanche gas prices tend to be higher than for Phantom, but at least they don't develop in such an ugly way. Meaning that over the years, I could see Avalanche actually outperforming and being able to hold more traffic and more load compared to Phantom. When looking at Avalanche's total value locked chart in AVAX tokens, it's not as volatile as for Phantom. In US dollars, of course, it also had quite a bit of a drop with all of crypto going down. But the ecosystem around AVAX seems to be somewhat more robust. Money isn't flowing out that quickly. The gas prices aren't going up that much. The only issue with Avalanche is its token inflation, which I think is at around 30% per annum or so. Very, very high. And Avalanche is probably, that's at least my impression, very much competing for similar projects to what's hosted on the Binance Smart Chain. It is cheaper in terms of market cap to total value locked, The Binance Smart Chain is very expensive. But if you're looking at a real competitor, right now the Binance Smart Chain I think has the best shot at it, because money is also more or less automatically flowing from the centralized Binance to the Binance Smart Chain. It's the same branding, directly profiting from all those marketing efforts. It's something that other blockchains don't necessarily have. But the upside, of course, of BNB is limited, given that it's already at market rank number 5, or in terms of volatile assets at market rank number 3. I'm still kind of flabbergasted that XRP is directly behind BNB. There is quite a bit of a jump, but still, XRP, I think, should in no means be that high on the list. Let's actually look at this for the fun of it. XRP relative to BNB. That's the performance. So I should probably just give it more time, wait longer and longer. And if you find a way to be long BNB and borrow XRP, betting on a short position here, this is probably pretty massive. Yeah, 99.93% underperformance. So I don't think it's a bad idea to bet on something like this. I personally am not an XRP fan, and BNB obviously has way more fundamentals behind it, way more adoption, bigger ecosystem. Betting on this gap further increasing and BNB rather growing while XRP rather declining, I don't think that's a bad bet to make. Of course, this is relative valuation, right? So this here looks like a constant, nice little bet. You don't want to just bet on XRP versus the US dollar going down, right? Because it can go up quite massively when overall crypto is bullish. So make sure that you're betting on the delta, that you're swapping your XRP for BNB and let that ride, and then pay back your XRP loan with the BNB that hopefully outperformed. So a lot of interesting ideas. We don't necessarily always have to play the macro game. We simply can just play the micro game, look at relative performances, look at, for example, how Cardano, this is another thesis of mine, is likely going to underperform a lot of other coins. The adoption and the technical issues of Cardano are also quite an issue. So I might go into more fundamentals for a single coin in the upcoming update. So these are just small remarks. But yeah, you definitely want to bet on something where you've got a working product, especially when the chains that do have failures, that don't have a great thriving community with a lot of transactions, are still so expensive, right? I don't think it takes too much of a brain to see how XRP is currently expensive, how Cardano is currently relatively overvalued, and how, let's see where ICP is. Oh, it looks like Internet Computer went now down quite a lot already. Yeah, ICP is at 37. I think it also doesn't take too much of a brain that this is expensive. VeChain probably the same. So there's no need to necessarily always time the overall market too much. All you need to do in order to get some money is to identify the relative losers. You don't even have to identify the winners. And it's probably easier actually to identify the losers because, as so many people say, right, 80 to 90% of all cryptocurrencies are going to fail, are going to underperform. And so why not just bet on that? Why not bet on the side of the 80% failing cryptos and bet on them falling rather than trying to find the very small fraction that might outperform, right? This is ICP versus Bitcoin. Why not try to find a place where you can get a loan denominated in ICP, swap that to Bitcoin, and let that continue to go down and make you money over the years. This is not even a very long-term chart, right? This chart starts here in May 2021. So that's all it needs. Look for something with a lot of inflation, with a lot of insider selling, with a lot of underperformance, and find ways to borrow those assets and see them further declining, making it easier for that ICP denominated loan to pay it back in the future. That's it for today's Macro Tower update. Wish you a nice Sunday. Hope you enjoy your weekend.